Welcome to Financial Investing Radio, where you'll learn the secrets for consistent, high-probability returns in the financial markets for additional income to change your life. Grant applies consistent, high-probability trading systems for the financial markets. He's only recently started sharing these tried and true market secrets. As a gift to listeners, Grant is offering his roadmap to high-probability financial control. Go to financialinvestingradio.com and download yours today. Now, here's your host and trading veteran, Grant Larson.
Everybody, thanks for joining. This is Grant. So I got to tell you a story. One time, many years ago in England, I was boarding a train and was loading my luggage and my bike into the luggage car, right? So back then they had a separate luggage car for large things. So I took my bike, put it into the car, went and locked it up, turned around, and I said to one of the train guys, "Hey, I'm just going to go get my luggage." So I turned around and ran back across the platform to get my luggage, only to see that same guy, he totally ignored what I said, and he told the train engineer, "Go ahead." And the train started pulling away. And I said, "Hey," and I yelled at him, and he just looked at me and ignored me. I picked up my luggage, and I ran to the train, and I chased it. And as the door came by, I jumped onto the train. Really stupid thing to do. And I ended up, I was not able to keep my balance, and I fell off the train, and I took a serious roll on the platform. Now, this is an example of trading with profit potential. All right, the profit potential was, I can catch that. I can hop on, right? I can make this train. That is not an example of trading with risk potential. See, I was clearly trading, with a profit potential mentality, right? And in reality, the profit potential did not work out, right? If I would have traded that situation, like it was a risk potential situation, I would not have tried to jump onto the train. Right? Now, the risk is that I would have lost my bike, right? But I would have protected my capital. In that case, my capital was my body, and potentially it actually could have been my life. So, I took a profit potential opportunity, not a risk potential opportunity. Now, that experience taught me a lot about the markets. We trade risk potential, not profit potential. All right, can you see the difference? All right, the skill that we need to learn is how to calculate risk potential. How do you calculate risk potential? How do you know what the risk is? All of us can look at a chart and we can say, "Oh my gosh, look at the profit potential that's on there." Our minds, the patterns, capabilities in our brains, we see that. And then what you end up doing is you end up with the profit potential mentality, you end up looking at a chart and you're saying, as a long-term investor, if it goes from here to here, look at all the money I'm going to make, right? Or as a short-term trader, right? If it goes from here to here, look at all the money I'm going to make. Looking at our investing or trading opportunities that way is actually introducing a lot of risk. So what we have to practice doing is trading with risk potential, like this train situation. If I would have had a risk potential mentality, when that train took off, I'd have said, "You know what? Risk has now gone too high. I'm not going to try to jump onto a moving train. And so, I'm going to lose my bike, but I will save my capital. I'll save my life. I'll save all my property. I'll save my body." I ended up getting hurt, certainly not too bad, but it was a really stupid thing to do. How many of us have done that in our investing, in our trading? How many of us have traded with profit potential mentality, not with risk potential? All right, there's three things I'd like for you to consider doing to help you with this, all right? Now, the first one is, for each market that you invest in, you got to understand its timing and its cycles, right? Some markets are seasonal, like energy stocks, right? They move in certain directions at various times of the year. So know the timing and the cycles of what you're investing in or you're trading, right? Or if you're trading during the day, right? You're trading futures like the ES, right? The S&P 500 E-mini contract. That moves more and less at certain times of the day. So know your market, right? That helps you understand risk, all right? But what I really want to talk about, the second thing, is some of the characteristics of identifying risk, right? What does it mean to know how much risk there is? Now, it can sound counterintuitive, right? But if we were to examine our investment or our trade opportunity with risk level, what would be those factors? Well, here's a few. I sat down and thought, let's see. The trend. So what that means is that if the trend is going up and I want to short it and go down, obviously my risk increases, right? So that's one thing. Another thing that we think about when we're calculating risk, okay? Think more about calculating risk than calculating profit potential, right? Think more about not losing rather than how much do I win, right? As soon as you do that, as soon as you get very protective like that in your thinking, it actually opens up the better opportunities because you're going to create this foundation for which then you can make good decisions. Okay, the trend is one thing. The second is the market structure. All right, so is it moving within channels, right? Or is it moving within a certain range? Things like that. You got to know that. All right, so look at that, right? How is this particular technology stock doing, right? Or how is this real estate stock doing, or whatever it is? The third is timing, and I already mentioned timing, but you got to know your market, all right? Know the general cycles and the timing of it. The fourth is the economic reports as it relates to that particular market. Be cognizant of that. Be cognizant of when they come out, all right? Jumping into, of course, an investment or a trade opportunity, around an economic report time increases the risk, right? So your potential for a good trade drops or your good investment drops. So you learn to wait for those things. Here's the next one, understand your key reference lines. You hear people talk about support and resistance, things like that. Well, it's actually very important to understand where those are. Here's another one. Understand the typical range of movement for the thing that you're investing in or trading. If it typically moves in a certain direction for a certain range of price or over a particular period of time and then changes direction, know what those ranges are and then know how far that instrument is in that particular movement of range. All right, here's the next one. You got to know the related market behaviors. What are those? What are the directly correlated and inversely correlated markets acting like? All right. So, for example, here's an obvious one, right? All right. So typically, when the stock market's going up, then what's going down? A lot of people say, "Oh, bonds," right? Or if the stocks, the S&P 500 is going down, then which way are bonds going? Up. That's not always true, but you want to understand both the directly and the inversely correlated markets and how are they behaving and responding. And then the last thing I'll mention in terms of calculating risk is to be able to understand multiple time frames of your market. What do those look like, right? What are the time frames of a market? And what's it? Let's say that you're a long-term investor, right? What does it look like on a monthly level? What does it look like on a weekly? What about a daily, right? Chart? You need to understand what's going on the broader context. All right. If you were to calculate risk into a number, what would that look like? What would be a number? Let's say you were to give a number or assign a number to each one of these right here. How much risk are you willing to accept before you take a position? And if we're not thinking that way in our investing or trading, then we are actually increasing our risk. So the third thing I would mention in terms of helping to protect us is to determine your participation level. In other words, after doing all that work, understand what amount or what percentage of your portfolio that you're going to commit to some particular opportunity. Some say 1%, some say 5%. You certainly want to keep it small, right? You want to protect your capital for sure. All right, so I've mentioned three things. Know the timings, right? Know what the key factors are that determine what risk is. Come up with a quantifiable number. I certainly have some numbers for that. Let me know if you're interested to know what those look like. You got to know what the risk potential is and what risk levels you're willing to invest in. So quantify that and then understand what's your participation level. Those things help you to control the risk and to keep it manageable so that you can, in fact, protect the capital, right? One of the things that I know for sure is, I haven't chased any trains after that. Lots of times in our investing and our trading, we will chase the train. We'll see it go in a certain direction, and we end up chasing an opportunity that actually often turns out to be not as profitable for us many times. And of course, in the case of my stupid train experience, could have cost me my life, right? So be safe, everyone out there. Thanks for joining, and until next time, know your risk.
Thank you for joining Grant on Financial Investing Radio. Remember to subscribe and leave feedback. Don't forget to download your free roadmap to high probability financial control before you make an investment decision. Visit financialinvestingradio.com now.